Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, how you doing?
I'm living the dream, my man, living the dream. What about yourself?
All is tracking well. All other than investment markets are tracking well.
Funny you should say that, because guess what we're going to talk about today with our listeners, or to our listeners, I should say, is the investment mistakes to avoid. Because, investment markets at the moment are all over the place.
Yep.
And we're having conversations day in, day out with our clients around it. And even though we've gone through this before, and even though we understand the education piece that's behind it and how markets react and why it's happening, it still causes a lot of discomfort, and people don't like looking at their investments and seeing such large swings with volatility and their investments going down. And it's really easy to make a mistake. So we thought we'd spend a bit of time today going through those, I guess, the mistakes that we flag and identify and talk to clients about, and try and educate them and try and avoid those mistakes as best as we possibly can. And that's what we're going to be talking to people about today.
Yeah, and it's pretty easy to do. I mean, I dare say, looking at this list and looking at a few of those things, it's definitely some mistakes that we've made along the way as well. And it's definitely something that you can pretty easily fall into. It's not like you have to be someone that doesn't have any experience in investing to fall into some of these traps. It's definitely something to be aware of and to take care of.
It's human nature too. Avoiding risk per se, I think, is just part of how we've survived as a species for such a long time. So it is part of human nature, and it does take a little bit of resolve to stick to a plan and stick to a strategy. And hopefully by outlining some of these, we can help some of our listeners avoid some of these pitfalls and not make the wrong decision at the wrong time. That's going to be detrimental for them over the longer term for their wealth creation journey. Andrew, let's get into it, mate. What's the first mistake that we talk to people about to try and avoid in investment markets?
First and foremost is not having a long enough time frame to invest. I mean, real easy and really common. Look, I've got X amount of money. I want to put it away. I want to invest it, and then I'm going to pull it out in a few months' time because I'm going to do this with it. Don't do it. Honestly, it's one of those things where knowing where the market's going to be in a number of years doesn't take a huge amount of skill. Knowing where the market's going to be in a couple of months takes an enormous amount of skill, and I dare say I don't think I've ever seen anyone do it with any form of consistency. So if you're investing, make sure that you're in it for the long haul, and make sure you're investing in assets that you can see yourself holding in a long period of time, not buying and selling, not trying to make a quick buck, because I would argue that that's not really investing. I'd argue that you're gambling.
Yeah, absolutely right. Absolutely right. And you're right. Longer term time frame is what it's all about with investing, because you are assuming risk, and to try and mitigate and minimize that risk, you need to have time to ride out market cycles, and obviously different cycles occur at different times, and you need a longer term time frame. So if you are investing for the short term, you're better off not exposing that money to risk at all and just keeping it on the side. It's a really easy one to forget, I think, in times of high volatility like what we're experiencing now, because you start investing, you've got a long-term time frame, all of a sudden markets start to go the opposite way. You don't like what you're seeing, and all of a sudden you change your mind and go in a different direction. So you lose track of what your investment objective is, and in turn, the long-term time frame that you had. So definitely, I think that's one to keep front and center when you're thinking about your investments. And one of the things to avoid when you're making investment decisions is to forget about the fact that investing is a long-term time frame.
Yeah, and look, some people can gamble. I mean, it's fine, and I don't want to make lies out of both of us. We've both at times said, all right, have an idea and I think that this stock might do well and I'm going to buy it and going to make a little bit of money in the short term. And that's perfectly fine, but just understand that that doesn't form part of your investment strategy. That doesn't form part of what you're trying to do to build your wealth. That forms part of the gambling, so to speak, that you're doing. And if it hits, great, but as long as whatever you're putting in there is nothing that you're going to miss.
I call it a donation. So when I lose money, I've actually made a donation to someone.
Yeah, exactly.
The second one on the list, which is probably one of my favorite, really simple. It makes sense. When we talk to people about this, it resonates, they agree with it, but doing it in practice becomes a lot more difficult. And what this one is just turning down the noise. So, and not that I want to blame the media or anything like this, but whenever...
Blame the media.
Yeah, well, let's do that, right? But the truth is, like, whenever something happens in the world, not necessarily just in investment markets, but the media thrives on negativity, and they grab stuff and they sensationalize it. And in today's day and age, the access of information on your smartphone, on your news feed, everywhere you go, you've got access to the media. It's really easy to get caught up in all of the noise and think about all of the disastrous things that the media are talking about and thinking that the world is going to end. And that will impact you and cause you to lose sight and lose focus and probably make irrational decisions. Definitely emotional decisions as well too, because you're so caught up with the fear that's being portrayed in the media and to a certain extent probably sensationalized sometimes as well too. So tip from my end, turning down the noise as best as you can. You still need to be informed, don't get me wrong, so you need some exposure to it, but just letting in what needs to get let in and then trying to block out the rest of it.
Exactly right. And this happens on the other side as well. I mean, you've got noise when things are going poorly, but you've also got noise when things are also going very well. If you were sort of tuning into media, it was cryptocurrencies taking over the world and sell everything and put it into that only 6 short months ago. Whereas that rhetoric has definitely changed. And so, yes, you want to avoid all of the negativity that's happening in the media and be able to sift through all of the, well, we're going to swear on a podcast, but sift through all of the untrue and sensationalized things, so to speak. But you also want to sift through a lot of the overly positive media on things may or may not pan out as well.
Yep. Real simple one. Hard to execute.
Yeah, exactly. Next one on the list is making sure that your investment strategy and your investments are well diversified. So what does that mean? It means you're not investing in one asset class. That means you're not investing in just one asset, putting all of your eggs in one basket. So long as you've got, again, a long time frame of investment, so long as you're investing in good quality assets, but also diversifying in a multitude of asset classes. Having money both in domestic and international investments, having money in shares, in property, in infrastructure, in bonds, in fixed interest, ultimately means that your investments are not exposed to just one thing that can impact all of your holdings, but rather having holdings across a whole range of different assets to help mitigate that risk over a period of time.
Yeah, so the idea and the theory and the concept behind this is that not all asset classes behave the same way in the same market conditions. So if you've got one asset class that's experiencing some volatility, maybe you've got a different asset class that you're exposed to that's not experiencing that. So not everything's operating the same way. You're diversifying, you're spreading it, like what you said, not having all of your eggs in one basket. So pretty straightforward. I guess that's probably easier across an investment portfolio. I think direct investments like things like property, obviously just because of the sheer nature of how much is involved to get into a property, that gets a little bit more difficult. But once again, not only just for an investment portfolio, but also in direct assets that you've got as well too, residential property, commercial property, and so on and so forth.
Yeah, exactly. And having, all aspects of that in your portfolio, some direct investments, some indirect investments, and really being able to utilize the benefits of all asset classes, because every single asset has its own benefits. There isn't one asset that is greater or better than the rest, and so naturally you need to take advantage of the benefits associated with each of those investments. Contrary to what a lot of people think, I mean, a lot of the times the question that we get asked is, what do I invest in and what's the hot topic right now to put my money into, which again, there's just no such thing.
Yeah, and it's easy to see how people get sort of drawn to that, right? Like, what's the one thing that I should invest in? But if we knew that, we wouldn't be here, right?
No, we'd still be doing the podcast, Bills. We love it.
Of course. Time in the market versus timing the market. So this is one that has been around for a long period of time, but essentially
said time a few too many times in that sentence.
I'm not even going to repeat it because I'm going to get tongue twisted on this one. Essentially what it is it's trying to demonstrate in a clear, concise sentence that picking the market in terms of your entry points and your exit points, so trying to time the market, is very, very, very difficult to do. Let's call it impossible. You can't pick it. I mean, in theory not in theory, with the benefit of hindsight, you can look at a chart and say, yep, I would have gotten in here and I would have sold out there. And it looks easy, but when you're in it, it's impossible to do. So time in the market is staying in the market, letting the compounding effect take its course, dollar cost averaging, rather than trying to go in and out. And there's also costs associated with trying to get in and out as well too. So buying and selling, that obviously attracts some costs as well too. But comparing the two different styles of essentially in and out versus buy and hold. And I'd add a little bit on top of that is continue to add to it as well too from a continual contribution or a dollar cost averaging strategy as well. But that's really time in the market versus timing the market. And there's countless studies out there about the impacts and the differences. And if you miss the top 10 days of a share market rebound or whatever it may be, how much you're foregoing just by that opportunity of trying to time the market, which you can't do. So,
and I saw a really interesting, it was a good visual demonstration. And again, I think we talk about it every few weeks about the fact that we probably need a visual element to this podcast. But if you actually chart out some of the biggest swings in the market, so the days where the market increases the most is generally clustered in with the days that the market is performing at its worst. So if you look at a calendar month, the days, the biggest increases and the biggest decreases tend to happen all within the same time frame, or tend to happen all clustered in together. And so what that means is that we can't accurately predict when that's going to happen. And so riding that wave and making sure that we're exposed not only on the upside, but accepting that, yes, we're going to get exposed on the downside is just a normal part of being in the market. And so making sure that you're staying in the market rather than trying to time it is absolutely imperative, because if, as you said, you miss out on those big days, all of a sudden you've capitalized your losses, you've missed out on the upside, and now you're behind the eight ball just to try and catch up your position.
Yeah, and something that we've been discussing and thinking about recently, you can't play the wealth creation game and only play when things are rosy, because you just can't. It's timing the market. You can't do it. It's too difficult. So it comes with the territory. You have to expect volatility. You have to assume risk in order to grow your wealth. You have to assume risk in order to partake in investment markets. It just comes with the territory. That's part and parcel of it. But having an investment strategy, which we'll talk about at the end, obviously helps with all of these things, and hopefully sort of ties a bow around that and has gets it into the right bundle. So yeah, Andrew, next one.
Next one, which I don't know whether it's just because I'm noticing it more now, but I find this is such a massive one in today's day and age that you didn't really see maybe 10 or 15 years ago, but well, maybe you did, but I don't know, maybe social media has just exacerbated it. It's chasing trends. We see it all the time. Whether it's, you can talk most recently about crypto and the trend that was around that, but before that, there's also lithium companies, there's miners, there's .com booms and tech stocks and all of that stuff. And some of it comes to fruition, some of it doesn't come to fruition, but ultimately trying to chase a trend or trying to keep up with the trends usually spells for not so great investment decisions off the back end of it.
Yeah, I guess if you're early on a trend, you can make some money. But yeah,
provided that you know when to go out.
Well,
I mean, Ponzi scheme is good if you're not the one left holding the bag, but
depends on the trend as well too. The greater fool theory as well. So there's always someone else, but we'll leave crypto out of it for now. But yeah, you're absolutely right. I mean, look, coming back to investment fundamentals and investment principles, you should always be investing in, I think, good quality, solid assets for companies that have been around for a long period of time or who have demonstrated a certain uniqueness about them that has a differentiation from their competitors. I think back to our mate Warren Buffett again, one of his quotes, You should be looking at a company that when you buy it, you'd be prepared for the stock market to close its doors for 5 years, and you'd be happy with that investment choice that you made, knowing that you can't trade out of that for a period of 5 years. That's one of the sayings that he uses. And if you apply that filter and that lens, that'd be the way to look at it. You won't be chasing trends. You'd be investing in good quality companies time and time again.
Yeah, exactly. And Bills, what's the next one on the list?
Well, this one here is a really interesting one, and it's not investing at all. Once again, sort of mimicking my previous comments around sort of wealth creation, you have to do it. You have to do it. And it's relative to every single asset class that you're considering putting money into. But if you don't invest, then I'm not going to say you're not going to get anywhere, because that sounds really negative, but you're going to forgo the opportunity to be able to grow your wealth. I think effectively. I think that's a fair comment. But not investing at all, I think, is quite dangerous within itself. And if you think about those things that we were talking about before, like turning down the noise and, letting the fear get to you, it can cause the opportunity cost to grow wealth is extremely diminished if you don't invest.
Yeah. And look, you can run through this exercise, and I've tried to with some degree of it being accurate, but try and consider how much money you would actually need to earn and how much money you would actually need to make in order to be able to reach your retirement goals without investing. So I would argue that even putting money in a savings account is investing, because you're banking on the fact that that bank or wherever you're leaving your savings is going to remain solvent. But you would need to have an exorbitant level of income, or you would need to make a huge amount of money on some other form of investment or lottery win or something in order to be able to have enough money that you don't need to invest at all and can still meet your retirement goals. So ultimately, yes, you need to, invest conservatively. You need to invest within your means. You need to invest funds that aren't going to send you broke if the market turns tomorrow. But at the end of the day, you have to do it. And so if you have to do it, and if you're going to partake in markets, then you have to accept that there's going to be some volatility, that there's going to be some up and down, and that's just a normal part of being involved and participating in investment markets.
Yep, well said. Can't get any simpler than that. You've got to do it. Next one.
Yeah, next one, which is sort of interrelated with almost all that we've been talking about, is really controlling your emotions. As much as I'd love to say that we went into finance being numbers guys, and you think, yes, all I'm going to do is just follow the numbers, and that's not going to lie, and I'm just going to follow what makes logical sense. But all too often, it doesn't work out like that. All too often, it's emotions that make decisions. And when you're making investment decisions based on emotions, you're pretty much setting yourself up for failure. Making sure that you're making rational decisions rather than irrational decisions is one of the biggest things that will determine your success or failure in investment markets.
Yeah, and that's why we're always, and not wanting to blow our own horn here, but that's why we always talk about having a financial advisor. Part of that conversation should be in their role as an investment advisor. The emotional aspect from receiving advice from someone else is taken out of it. So they're not impacted by the same level of emotion that you are when you're making your own investment decisions. Because that's probably the biggest one there that causes people to make mistakes with their investment journey. It's simply just that one.
And look, to give you a bit of an insight into that, and it probably is also a testament to our relationship as well, but Billy and I, as an example, if we're making investment decisions, sure, we have all the knowledge to be able to make those investment decisions on our own and manage our own finances. That's what we do day to day with clients. But decisions that we're making for our own personal investment growth or for our own personal wealth creation, we're talking about it amongst each other. Just because it becomes really easy to get tied up in your own emotions and not look at things logically. So even someone that's in the profession that's dealing with this every single day is still receiving advice, is still talking to someone else about it and having a bird's eye view outside of just their own mind.
Yeah, really good example, Andrew. Absolutely right. It makes so much sense. We do it all the time and it works because it removes the emotion and you're checking it across with someone who's not emotionally invested in that decision. So yeah, really good example. Probably the last one, and once again, leaning into that advice piece, is not having an investment plan. So if you don't have an investment plan, if you don't have a strategy, it's so much easier to get caught up and make all of those mistakes that actually we had just spoken about before. It's really easy to just go into it thinking that, yep, you're going to put money in, you're going to make a mozza and everything is going to be great. But there's so much to it. You need to understand risk. You need to understand diversification. You need to understand your time frame. You've got to have contingencies in place. It's really difficult to do, I think, unless you've got a well-rounded investment plan. And it's very easy to make mistakes if you don't.
Yeah, there's a saying that kind of rings true, but I don't think it almost hits home enough. And that's that trying to invest without a plan is like trying to plan a road trip without a map. But that saying assumes that you know your starting point and your ending point. But if you don't have a plan, you don't even have an ending point. All you've got is just a starting point and a whole bunch of things that you're doing. Even though as much as that saying makes a lot of sense and 100% it resonates with me, I don't even think it goes far enough. Really, not having a plan is a recipe for just running that rat wheel and just constantly thinking about what's the next investment that I can make, what's the next trend that I can jump on, what's the next thing that I can do to grow my wealth, without actually looking at the big picture and not looking at the implications of every decision that you're making. Because the investment decisions you make today aren't going to affect you necessarily in a month or 3 months or 6 months time, but will impact you in a year, 5 year, 10 years time.
Well said, Andrew. It's just an idea if you don't have an investment plan, I think.
Exactly.
That's all it is. So that probably rounds out our list of things to avoid, or the investment mistakes that are possible if you're not careful, and some of the stuff that we're talking to clients about a fair bit at the moment, because markets are volatile and people are looking at it, and obviously all of those things are coming into effect. So hopefully we did that some justice, got some value to our listeners. It helps them make better investment decisions and avoiding the investment mistakes that we've just highlighted.
Awesome. Billy, thank you again. A great podcast. Thanks to our listeners for tuning in. If you wanted some further insights, or you wanted to reach out to Billy or myself, details are in the show notes, and we look forward to catching you on the next podcast.
Thanks for listening today. If you have any questions on what we've talked about, or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorised representatives and credit representatives of AMP Financial Planning.